Hello, and welcome to the Investors Row podcast. My name is Kasia Baldus, and I'm here with Dennis Blitz, founder of IRA Club. And today we're going to take a look at mutual funds. Oftentimes we talk about alternative investments, but I wanted to take a moment to look at the traditional investment type, one of them being mutual funds. So Dennis, you have a lot of years in the financial industry, a lot of expertise. So we wanted to take a few minutes and just get your take on this investment option for our investors. And can you tell me what mutual funds are? How do they work?
And the real core question, for investors is, are mutual funds a good investment? And we're going to talk about that and how mutual funds kind of came about, how they are today, and, what are the advantages and disadvantages to mutual funds. The mutual fund actually is very important in American retirement because there is, believe it or not, $29 trillion invested in mutual funds today. And 121 million Americans own some mutual funds. So it's very likely that you own some mutual funds. It's very likely that part of that $29 trillion is yours. You want to know, am I making a good investment? That's a legitimate question. And we're going to talk about that and the positives and the negatives as we go along through that. It's not all positives as the mutual fund companies would kind of lead you to believe. So what we're going to talk about is the mutual funds which are offered by the firms Fidelity, Charles Schwab, Vanguard, and many others that offer these big mutual funds.
Okay, Dennis. So how did mutual funds come about? And tell me a little bit about the history of how we are here today.
The mutual funds came about a lot longer ago than many people think. They really started about 1924. And the person who really started them was Joseph P. Kennedy. Now, if you're old enough, you'll remember that Joseph P. Kennedy was the father of President John Kennedy. And Joseph P. was looking to make some money. And we're pretty sure that Joseph made a lot more money than the investors on those mutual funds. Mutual funds are still around. They became really popular starting in 1964, because 1964, a company named Dreyfus started advertising mutual funds on television. And what was their draw? Their draw was, we will professionally manage your money. So that's sort of the background of mutual funds, and I hope that gives the people a bit of a framework.
So I want to know just the basics of what are mutual funds and how do they work?
Mutual funds, very, very simply, are people are encouraged, if you call Fidelity, if you call Schwab, especially if you've got a retirement account like a 401k, they're going to try and drive you towards the mutual funds. And their pitch is very, very, very strong, very good. And it talks about professional management, and it leads you to believe you can leave your money in the mutual fund forever and ever because the professional managers are going to manage it for you way better than you can. And you can see the average person is going to think to themselves, well, wait a second, I'm not a professional investor. I don't know what to do. Let me have these professionals invest it for me. So mutual funds have grown and grown and grown, but they have some fees that we're going to talk about. Let me just talk about for a moment the evolution of mutual fund charges, because charges are very important. And remember, everybody who has a mutual fund always goes and thinks about what's called the NAV, the net asset value, which always kind of surprised me that nobody ever said, why isn't it called the asset value? Why is it called the net asset value? And we're going to see here in a few minutes exactly why that is. Okay, so mutual funds, as I said, really got rolling in the 60s with the Dreyfus ads. And back then, mutual funds had what's called a front-end load. Front-end loads were generally set at about 8%, and they went up from there. There were some that were as high as 15%. There were some even higher than that, but that was really getting rare. But the base front-end load was about 8%. And number two, the next thing that happened was the mutual fund companies learned, just by observation, that people who had mutual funds seemed to keep them a long, long time. So they decided that this was an opportunity that they hadn't realized they had. And at first, people didn't like the front end load. You can almost imagine it. Let's say it's 8%, and you would say to the person, wait a minute, I'm going to give you $1,000. You're immediately taking $80 off the top, and you're only investing $920. I'm behind the eight ball even before we begin. So people didn't like front end loads. So mutual funds did two things. One, they got rid of the front end load. No load funds. Matter of fact, I don't know if we can even find a front and loaded fund anymore. So they are no load funds. Don't pay anything to invest. Now there are some fees along the way, but don't worry about them. That's for the professional management. Okay, so let's talk about how that happened. You want to talk about how that happened?
Yes, please.
Okay, let's. So the idea was that mutual funds are a profit-making business. You expect that, but you don't quite know how much of a profit they're making because they do a very good job of kind of concealing that, and we'll show you how they conceal it in a few moments. So let's say there's these professional managers. Now, there's quite a few of these professional managers, and these people are pretty well paid. Okay, where does that come from? Well, it actually comes from the mutual fund. So every day we take a little money out because we've got to pay the professional manager. Now, let's say that you own the mutual fund company. If you were taking money out to pay the professional manager, would you also mark that up a little bit so the mutual fund company could make money? Sure. So it's not only are you paying for the professional manager, you're paying a profit to the company. So is Fidelity making a profit hiring those professional managers? Is Charles Schwab making profit? Is Vanguard making profit? Of course they are. We expect that. Okay. All right. And the professional managers are supposedly working in our best interest. That's okay. Okay. But wait a second. There's other things. I said there's there's $29 trillion in mutual funds. That's a lot of money. Are there bookkeepers for this thing? Are there accountants for these things? Of course. So every fund company has to hire quite a large staff of accountants and bookkeepers, etc., just to track the dollars in and out and where they're being invested. And so who pays for all that bookkeeping? The mutual fund investor. And if I'm the mutual fund company, do I charge a up fee on that so I can make a profit? Of course I do. Well, wait a second. Are there any other fees? Kasia, you would be surprised. There are fees all over the place. And, the more we get into this, I think of the old Chinese, torture, death by a thousand cuts. And that's what a mutual fund is. It's death by a thousand cuts. Let's see. There's the investment management fee we just talked about. Well, okay, I can see that. Then there is the invoicing fee, the fee for all the bookkeepers and accountants that have to be there. Are there attorneys that work at a mutual fund? Well, of course, there are mutual fund attorneys. And is there a markup charged by the mutual fund company on their fee? Yes, yeah, on their cost, of course. Is there a transaction fee? In other words, every time the mutual fund chooses to make a new investment, they have to go to a brokerage firm and make that transaction. Now, the people who work at the Schwab mutual funds, what brokerage firm do you think they use to make the transactions? How about Charles Schwab? What about the people at Fidelity? What brokerage firm do they use? How about Fidelity? And on and on and on. And so does the firm make a profit on those transactions? Of course they do. Well, wait a second. There's a lot of fees. What about legal, accounting, auditing? Uh, uh, Wait a second. They advertise. Does the advertising cost come out of the mutual fund? Yes, and it does. So all these fees are charged to the mutual fund.
So, wow, Dennis, this sounds like there are a lot of fees. So, if an investor has a mutual fund, do they get a clear invoice where they could see a breakdown of this and that way they could run the numbers and see if this is a good return on investment?
Well, you would think that, wouldn't you? Yes, and I would think that too. However, every mutual fund owner that's listening to this is saying, wait a minute, I've never received an invoice. How could this fee be? There's no fees. I don't get an invoice. And mutual funds learned a long time ago that if they take the fees in little tiny bits, you won't notice them as much. Well, you'll notice them in the end, but you don't notice them as much. So what happens is every day at the end of the trading day, they take all the assets of the mutual fund and get the asset value of the mutual fund. They take all the fees they're going to charge that year. And you can see I've only listed a few. There's a lot more. But they take all the fees they're going to charge for the year. And there's approximately, about 260 business days per year, approximately. If I'm wrong, change the number a little bit, but not much. And so they divide that annual number by 260. And then they bill not you, which is why you don't get an invoice. They bill the IRA. So they just bill the IRA once a day for 1/260th of the annual cost, and which lowers the value of those shares that you and I own. Hence the phrase net asset value. And that's where they make their money. So you never feel the charge. But there are all those people well paid and all the markups, generous markups that your mutual fund is paying. I can tell you that we've added up what those fees are. And it's been done several times. They are kind of most of them are hidden in the prospectus. One of my favorite ones is there's a 12B1 fee. They always list the 12B1 fee in the prospectus. If you ever read the prospectus, and most people don't, they rely on that. But even if you got to the 12B1 fee, you're looking at it and say, "Oh, I don't even know what that is. It couldn't be much." The 12B1 fee is a commission. So the person that sold you those mutual funds is getting a commission. How long will he get that commission? Every year you hold that mutual fund. And it's a 12B1 fee, and on and on. And all these fees are going to be here every day, not every year, every day, as long as you hold the fund. So when we add it up, we get, as I said, about 3.9% annually. Some people have added it up and get a higher number. The numbers that go above about 4.4, 4.5, I'm not too sure. I think those numbers are incorrect.
Okay, so let's say we took an investor who had $100,000, whether that's in an IRA or their personal funds, and let's say they invested it using a self-directed IRA versus a mutual fund. What are the fees looking like, and how much is the investor really paying in fees?
As I said, there's a substantial fee on the mutual funds, and keeps adding up and adding up and adding up every year. The IRA companies, and not just IRA Club, but IRA companies, all clearly show their fees, clearly explain their fees, clearly say their fees. IRA Club, as you know, the fee for having an account is $195 per year. And let's say you bought a house for $100,000 and put that in your IRA. So the IRA bought a house. We charge $195 per asset for an asset. So instead of $78,000 over 20 years, you're paying literally $390 a year compared to $3,800 a year. So there's a big savings in self-directed IRAs. Now, all those fees that I talked about have an effect, and the effect is simply stated this way: mutual funds, because of the fees, have underperformed the S&P 500 39 of the last 40 years, and will continue to do so forever into the future, because that's the way they're set up.
So, after looking at the history of mutual funds and the fee breakdown, what is your final take on mutual funds?
If you want to make money in mutual funds, my final take is be a mutual fund company, because they're the ones making the money.
Dennis, thank you so much for joining us. As always, your insight is so valuable, and I've learned something today about mutual funds, and I'm hoping to learn something again soon.
Great.
And for all of you listeners, if you'd like more information, please visit us at www.iraclub.com/podcast, where you can go ahead and download Dennis's book and learn some more information about self-directing and smart investor tips. Thanks for joining us, and we'll see you next time.
The information contained herein is intended to help the viewer successfully navigate common IRS and Department of Labor requirements to help achieve successful results from their IRA. The information is not intended to replace information from your legal counsel or income tax professional. IRA Club does not offer or sell any investment. All investments have risk.